I'm 60. So
Yep.
how does that factor in?
You can't do that if you're just buying the policy today.
I've showed clients this before, and it sort of blew their mind.
So today, it's all about the impact age has on your life insurance policy.
Right.
When we talk about life insurance in this context, we're talking about using the cash value of life insurance and accumulating that as an asset you're going to use for some purpose. Typically,
we're using it as an
income.
investment. I'm using air quotes.
Yes.
All the regulators who are listening but not watching.
Well, now that we have a video format for those listening on audio, remember
we can
you can head on over to YouTube. We can put down as you somewhere on the screen.
Yeah.
Don't listen to us.
Right. We can put a disclaimer right before. We're idiots. We have no idea what we're talking about. This is not meant as personalized advice.
Investment doesn't mean investment.
Well, it means investment in the truest sense of the word, not the one that the investment industry has co-opted and made a legal term, I guess.
Correct. It's like when realtors tell you that you're going to make the best investment in yourself when you buy your home.
That's exactly what we want to equate ourselves with, Brandon. Good work.
They get away with it. We need to as well.
That's right.
So time has an impact on your savings.
This is true.
Should we say there's leverage that you can apply on your savings, including life insurance, when time is on your side?
Yes.
Which means the best time to start your life insurance savings plan is today.
Or yesterday.
Yes. Yesterday would be even better.
Listen, we're throwing out all the successories. Yesterday was the best time, but the next best time is today. So.
Yes. There you go. But there's truth to this. There is truth to this.
It's multifaceted, right? Because there's just the power of compounding, which exists with any kind of savings, is not exclusive to life insurance. Which is your time factor. But then something that is unique to life insurance is the underlying costs of the insurance itself, which are significantly lower at younger ages versus older ages.
Right. I would argue that the compounding element of life insurance is perhaps more leverageable than it is, let's say, on the stock market.
Yeah.
Because there's always the chance that you idiotically fall into the right investment at some point and just go gangbusters. And at that point, compounding didn't really matter.
Right.
Now, that's a hope and pray strategy that does not work out all that well for a number of people. But in some situations, if you get lucky, you get lucky.
Yep.
Life insurance, on the other hand, is going to compound continuously for forever. Capitalizing on that as early as possible is quite beneficial.
Right. Some might say leverage.
We have, I think, been very, very open about the fact that given enough time, even a poorly executed whole life insurance policy, for example, becomes quite valuable after a while and gets to a point where there's really nothing one should do to it. Yeah. Because there's no way to overcome the inertia that has been built over years and years and years and years.
Coupled with the fact that we've seen many that were 20 plus years old. The policies haven't performed all that well, but the inertia, as you mentioned, plus the fact that they bought it when they were 20 years younger. So the costs were just that much less. The one caveat to what you're saying about even a poorly executed whole life, we mean that in the context of it's a dividend paying, participating whole life policy.
Right.
I mean, if you bought a non-participating whole life policy, it is not going to necessarily get better over time. I mean,
no,
incrementally speaking.
But without dividends, there's very little chance that it's going to be an attractive asset from a cash accumulation point of view. Still works as a permanent death benefit, still works for all the guarantees that are associated with whole life insurance. But one does not buy non-participating whole life insurance to do the asset accumulation, the bond alternative allocation that we talk about so often. That doesn't work unless it's a dividend-paying whole life policy.
Correct.
So I think I want to set the stage today with a little example, just to highlight compounding without factoring in lots of things like life insurance expense.
Okay.
So if you had 30 years, you've got a 30-year time horizon, and you are looking at trying to get to $500,000 of account balance, let's assume you're going to get a 4.5% rate of return year over year.
Right.
The amount of money that you would need to save in order to get there over this 30-year time period is basically $29,500.
Okay.
So if you save $29,500 per year at 4.5%, 30 years later, you'll have $500,000.
Right.
If you were to wait, and now you've only got 15 years, so we're going to compress our timeline in half.
Right.
The amount of money you would need to save on an annual basis to get to $500,000 is now $44,500.
It's a little bit more.
That's a lot.
Yes, it is. You cut your timeline by 50% and you increased your savings by 50%.
I mean, not quite, but it's
pretty close.
Yeah, it's a leverageable aspect to this. If you start earlier, the amount of money that you would need to save is far less. And consider the fact that you may be wrong about what you assumed your rate of return would be.
Right.
So maybe we get to 15 years out and we find out we're way closer to that $500,000 than we thought we were going to be.
Yeah.
We may be able to save less moving forward.
Right.
Or we may continue to save the same amount and just have more money.
Yeah.
But time is absolutely on your side.
Yeah.
If you're willing to leverage it on your side.
Absolutely. Yeah. There's an interesting quirk to life insurance that I'm not sure exists with any other vehicle. And that is, there's just another component to the time factor here. And that is that the longer, up to a point, I should make that caveat, up to a point, a whole life insurance policy's year-over-year rate of return increases.
Okay.
So we talk about it in terms of average rates because the compound annual growth rate is the rate that matters if you're looking retrospectively, right? But there is I've showed clients this before and it sort of blew their mind. The fact that you could have something like a 4.5% compound annual growth rate on a whole life policy is actually pretty amazing, considering that even a well-designed whole life insurance policy might have a negative 30% the first year or 40%.
Yeah.
So if you start thinking logically about that, you're like, well, at some point, this thing's going to have some pretty substantial year-over-year gains.
Yep.
To get us to an average of 4.5. And they do. So all I'm saying is the earlier you start that, the earlier in your life you're going to get to the point of that thing really starting to gain a lot of steam. And that's why I was just dovetailing on to your earlier point. That's why it pays to really start earlier rather than later. That's another component. That's a really good point.
And we have had conversations on numerous occasions with clients who bought policies largely as a diversification play.
Right.
So I've got cash in X amount here. I could put it in the market, but I've already got market stuff going on. So why don't I just buy life insurance?
Right.
And because I've got a fixed number of dollars.
Right.
I'm not really interested in signing up for a 15, 20, 30-year commitment to premiums.
Right.
Even though cash optimized policies really aren't a commitment in that sense. But they're compartmentalizing the thought process to say, hey, look, I got $250,000. I want to move this to whole life insurance, for example.
Right.
So let's do that. And we do that. And to do that, optimally, we have to break it up into a certain number of years and move it into the whole life policy. Now, the majority of the time that we do these things, once we get to the end of that initial period of dollars going into the policy, it's very common for those policyholders to come back to us and say, hey, so like I got one payment left and then all the money that was supposed to go there, it's gone now. It's in the policy. That's good. Love it. Just kind of wondering, should I continue to put money in here?
Right.
And it's funny. That's always the way they ask. It's not, can I? It's not, what do you think? It's always, should I? And my answer 100% of the time is, well, let's look at the policy. And let's say this year, the increase of cash value, given the premium that you're going to pay, is going to be something like 5.5%.
Right.
Is there some other asset that you've got or could get into that you're going to take this other money that you now have, that you didn't have however many years ago it was that we started this, that you could take that money, put it in this other asset, and virtually guarantee yourself a 5.5% increase or rate of return on those dollars?
Right.
If the answer is yes, you've got something you could do way more than that, then do that. Don't put it in the life insurance.
Right.
The answer is no, then sure, put more money in the life insurance. Why not?
Right.
Because if something else comes up and you want it to go somewhere else, that's totally an option with whole life insurance. You could take it out. But that's always the equation. And that was a really long way of getting to this point. You can't do that if you're just buying the policy today.
Right.
You have to have owned it for a certain number of years before that opportunity is on the table.
Yes, it's absolutely true. That's why I think we can give some credit to, or I can give some credit to Nelson Nash for providing this idea for all you IBCers out there that love internet banking. I'm gonna throw a bone to you and to Nelson Nash, and that is that he talked about, when using life insurance in particular, it takes time to build the capital, and so as long as you go into it with that perspective, I think you are on the right track. And that's something that we've tried to communicate with our potential clients, is that if you have a short-term view of this thing, you're not going to be very happy with it.
Mm-hmm. There's far too many people, and to be honest, it's really not that many that we talk to personally, but because there's probably two, there's far too many who want to fast track all that stuff. And the number of times that I have had conversations, and again, it's not many, but it's coming from somewhere. And the ones that will show up and like, how soon can I take the money? How much can I get? It's totally going down the wrong path.
Yeah.
And that was a foundational aspect for infinite banking. Number of, I don't know about true IBC practitioners, like the ones that pay to be part of the program, but kind of more the ones on the fringe who have all of their fanciful cash flow, whatever, trademarked this pitch on the internet these days. There's a lot of let's supercharge the whole thing and get ready and put all your money into life insurance and kind of put all the money in there first, then pay all your bills and leverage. And no. It does take time, and it gets a whole lot better with that time.
Yeah, it does. One of the things that I think we should address, and that is, since we're talking about the ability to leverage long lifespans and life insurance here, is because I know people are going to ask, because we talked about how it works great if you start earlier. So people are wondering, I'm 60. So how does that factor in?
Well, if you're 60, it's not going to look so great, as we just sort of covered, if you buy a policy today and say, I want to start using it for retirement income at 65.
Right. We've had many conversations with people who wanted to do something like that.
Yep. And I think if that's what you're looking to do, annuities, dividend investments, those are worthwhile pursuits at that stage in life.
Right.
Life insurance, if the income has to start that soon, it's not going to work. Now,
right. It takes a longer time because of it costs more to insure you at 60 than it did at 25 or 30. It takes longer to get a positive rate of return out of a policy when you're that age.
Yep. And if you're 35 and you want to start income at 40, it's also not going to work with life insurance.
Right. Absolutely. That is 100% true. I think, so the answer is, we're winding around here to get to it. The answer is, you can definitely do it if you're 60. That's not an issue. It's how long are you going to let the money, I always say, percolate? How long are you going to let the policy grow before you start tapping into it? If you want to tap into it as a regular income source, meaning you're taking a certain amount of money out of it every year, if you're 60, I would try to arrange my assets in such a way that I didn't need to touch the policy till I'm something like 70 or older. 10 years is kind of a good benchmark. I'm not saying it works perfectly in every circumstance, and that it couldn't work earlier in other circumstances. But 10 years is a good gauge there.
It is. And, as time goes on throughout one's lifetime, there may be things that are just no longer on the table because you waited too long.
Right.
It's not a complete impossibility, but the odds of being able to successfully go to med school or law school at 50 and have an illustrious career in medicine or law, it's not
impossible, but it's a low probability.
Yeah. And so if you wait till 60 to buy life insurance for retirement income purposes, again, not impossible, but the probability of success starts to diminish. Now, that doesn't mean that if you're 60, you should take life insurance completely off the table, per se.
Right.
There are other things that are not unrelentingly related to retirement income generation that may be attractive to a 60-plus-year-old as it relates to buying life insurance for cash accumulation. I mean, death benefit, that one's a little more obvious. But to the individual who says, hey, I'm not doing income, but I sit on $300,000 of cash, and I'd like it to grow a little faster than cash, or have some of these features that you've talked about, have the ability to tap it for some purpose. It's not going to be a systematic thing, but who knows? 5-10 years down the road, maybe I want $50,000 to do something. And I like the idea that it continues to grow even if I take a loan against the balance. Or I like the idea that I have this cash position plus a death benefit that is larger than the cash itself that I could leave to somebody. Because ultimately, this cash position, I'm not intending to spend it down. It's going to go somewhere and to someone. So if we can create a larger pot of money through the death benefit of the life insurance policy, that's cool. Plus, I don't lose the actual buying power of the cash that I have with the life insurance policy, because I'm basically just going to take it out of one pocket and stick it in the other one.
Yes.
And there's the fact that once I'm gone, the transfer of this value to whomever I've named as the beneficiary, that happens a whole lot more simplistically with life insurance than it does if it's cash in the bank or in a brokerage account. So
you skip probate, it goes paid directly, and there's no income tax consequence for the beneficiary. So
it's not necessarily the case that once you're older, life insurance just isn't workable anymore, but the options that you may use life insurance for shift around.
Right.
And that's just the way it is. But income becomes a significantly less probability of success scenario as you wait longer to use life insurance for this purpose.
Right. Yeah, that's actual leverage, right? Like, not a buzzword. It's actual leverage to be able to pay. I'll just use, pulling numbers out of the air. If you're 65 and you got $300,000 using your example, and you can put it all into a policy in relatively short order, maybe all at once, doesn't really matter. If you're buying it for death benefit and you get $1 million death benefit out of it, well, I mean, you just bought $1 million for $300,000.
Yeah.
Now it's not for you, obviously. It's going to be for your beneficiaries. But anytime in a financial transaction when you can, I stole this from someone else, but you're buying dollars at a discount, that's a no-brainer.
Yeah.
Depending on, what your circumstances are.
And you know what? There may even be an application where it's for you.
Right.
Because most of these policies have accelerated death benefit features, which gives you access to the death benefit under certain medical conditions.
Right. Or long-term care riders or whatever. Yeah, there's any number of ways that it can benefit you. And you still have access to the cash. It depends, on in that scenario that I talked about particularly, probably you don't need the cash, or it's going to be a last option that you would land on.
That all on its own has some benefits to it.
Yeah, absolutely.
I don't know about you, but cash in the bank is a whole lot easier to go take out and do stuff with than cash in my life insurance policies. Like if something intriguing comes up, we go to the bank, we get the money, and we spend it.
Right.
If I have to go to the life insurance policy to do it, there's a little more pause behind that. And that pause is not a bad thing.
Right. Right. Going to take a week or so.
Yeah.
To get the money. So.
Or just the fact that I got it, like the fact that it's coming from the life insurance policy makes me think a little bit harder about whether or not I should make this expense.
Right, because there's a decision about what I'm giving up by virtue of taking it. Yeah. If it's in your checking account, you're not really giving up much of anything. So.
And there's maybe it's just me and I'm weird and there's a psychology thing here, but it just seems like a much more substantial decision.
Yeah.
If I'm going to take it from the life insurance policy.
Yeah, I think so.
All of those other things aside, just the mere fact of taking it from the life insurance policy makes it just a more substantial decision.
Yep. And I think that's true for most people. I don't think you're alone. That's absolutely true.
But I want to be unique.
You want the cash flow and the leverage cash flow.
Registered trademark.
That's right. That's right.
So all of these things that life insurance can do, it can do a little bit better.
Yeah.
The longer you've owned it.
That is true.
And having a policy that you're able to use over your lifetime will definitely unlock some opportunities that most people don't think about years ago when they first buy these things.
Yep.
It's definitely been the case for us. We've had older clients who bought life insurance. Some of them when they were younger, some of them as they were more, maybe 50s. And they get to see what happens over a span of a couple of years, and they start to become really big advocates.
Yes.
And they start to face the same frustration that we face, because what they discover when they go to the 30-year-old and say, hey, young man, you should do this. And they go, I got other things going on. And they kind of want to shake them.
Yeah.
Like, and then you and I've even had this conversation with some people, some shall we say, experienced individuals, aged individuals,
seasoned,
who, seasoned. That's the word I want. Who come and to us and they're like, hey, because you guys have been doing this long, you must be experts at this. I'm trying to convince this nephew, this cousin, this kid, this whomever, that this is something they need to do now. Like, don't wait, do it now. So what do you do when they don't listen? And we tell them, hey, if you figure it out, please tell us.
Yeah, I was going to say, I have a 100% success rate of 0% at convincing anyone to do this.
Yeah.
Are
you telling me 100% of the time it works, none of the time?
That's right. The 100% of the time I fail.
Yeah.
At convincing anyone. It's too abstract, I guess, and goes completely in the opposite direction of the mainstream. So that's a lot of inertia for people to overcome when every personal finance guru in the known universe hates whole life insurance, hates annuities, hates everything that's related to insurance, basically, other than term insurance.
And I'm sure that plays a role at the margin, but I think the majority of them just got other things.
Yeah.
I'm worried about other things. I'm focusing on other things. I believe in other things. And life insurance plays an important role in preservation. And you don't think much about preservation until you start to get a little older.
Right.
Because you don't usually have life experiences that highlight preservation.
And even more fundamentally, you don't really start to consider preservation until you have extra cash.
Yeah.
And so that being said, we have had a lot of success in working with younger people. And when I say younger, I'm framing it late 20s, early 30s. But these are people that earn way above average incomes and have excess cash. I hate to call it this. A lot of people call it disposable income. I've never met any disposable income in my life. Discretionary.
Yeah.
I don't care how much income I have. I'm not throwing any of it away. So, discretionary income, meaning you make more than you spend on a month-to-month basis. So really the conversation with that younger nephew has nothing to do with life insurance. The first thing you have to convince him is not spend all the money that he makes. And I can't do that. And in my experience, no one can do that. It's a real, you can have the head knowledge. You can make sure they have the knowledge to understand the math, the simple math behind that. It's not complicated. You know why I know it's not complicated, Brandon? Because you and I both have experience in our families of people who are quite uneducated, but grasp this concept very, very, very well. So It's not complicated. But until they buy into that idea, nothing else is relevant. What financial product they purchase or use is completely irrelevant.
Yes. And for a lot of people, that's just not going to come home to roost for some time.
Right. Unfortunately. It took me until I was much older. I can assure you. It did.
Yeah.
So.
All right. Well, I think that covers everything we came here to squawk about today.
Sounds good to me.
All right. So with that, I am Brandon Roberts.
And I am Brantley Whitley.
And we will see you next week.